Hello and welcome to the Multifamily and More Expert Series, where we dive deep into a specific topic with our expert guests in the area of real estate, mindset, or anywhere in between. My name is Jamie Gruber. I'm your host, and my guest today, Chris Peters, is a capital advisor at Stacksource, and we're going to dive deep on a very, very interesting topic today. Chris, how you doing?
Good, Jamie. How are you doing?
Great. Glad to have you here. Really happy to get into it. Before we go into it, I just want to mention a couple of things. First, our podcast is brought to you by CF Asset Group, a multifamily holding company. We are currently partnered up with Warrington Capital, sourcing 80 plus units, really anywhere in the country, mostly on the eastern side of the U.S. So go to cfassetgroup.com, check us out. You can enter your information in there if you want to work with us, have deals that you want to go over with us, or whatever the case may be. Second, we'd love for you to subscribe to our Multifamily and More YouTube channel. If you're watching this, you're on the YouTube channel right now, make sure you hit that subscribe button and the notification bell so you can get more and more updates like this with some valuable content. So business aside, Chris, you are an advisor with Stacksource, and you and I have talked recently about a deal that we're working on, and we'll talk about what Stacksource is and how that works. But in general, you're in the mortgage lending industry. And we'll get more into that in a moment here. But you wrote an article recently talking about something interesting called the loan constant or mortgage constant.
Yeah.
And it fascinated me. In fact, I reached out to you and said, man, that's one of the best articles I've read. It was right on the, and so I just want to start with what the heck is that?
Yeah.
And let's roll from there. So what is a loan constant or a mortgage constant?
Sure. So, we get this all the time. A lot of people ask us, they come to us for financing, and they bring us a deal, right? And they say, hey, the number one thing we want to know when we're financing a deal is what's the interest rate, right? So what people don't know is with a commercial loan, oftentimes it's an amortizing loan, right? You're paying back principal over some scheduled period of time, whether it's 20 years, 25 years, 30 years, but you're paying back principal. So if you take a cap rate of, say, 6% and compare it to an interest rate of, say, 5%, people tend to think, oh, great, I'm earning more on that 6% than I'm paying on that 5%. But what they don't realize is that 5%, they're actually paying back principal, right? So that 5%, while that's the 5% interest rate on the debt, you're actually paying back principal over the entire life of the loan. So the loan constant is a way to calculate what that effective debt service is on that original loan amount paid over the entire year. And so, Jamie, if you want to pull up a slide here.
Oops. Yeah. We had this in the beginning, but I got it now. Here we go.
Yeah.
So there we go. So I'll pop over to the second slide.
Sure. Perfect. So it's essentially, it's taking the interest rate and going one step further. It's adding in the principal that you're paying back on an amortizing loan.
Yeah. The
loan constant is always going to be higher than the interest rate. So if you have a 5% interest rate, it's going to be somewhere, north of that 6, 7, 8%. And it really depends on the amortization, meaning how quickly are you paying principal back. If it's a shorter amortization, like 15 years or 20 years, that means you're paying back more per pay period. So your loan constant is actually going to be higher. If you're having say a 25 or 30-year amortization, you're paying back your principal over a longer period of time, meaning each pay period, the payback is actually smaller. So your loan constant won't be as high, but it will always be higher than the interest rate. And the way to calculate, if you look at the third bullet point, is really just the total annual debt service over the original loan amount. So if you look at an example, let's use 5% interest rate, 25-year amortization, meaning you're paying back that principal over a 25-year period, and then a simple $1 million loan amount. So if you plug that either into an Excel or a financial calculator, or do it by hand, you get to an annual debt service of about $70,151. If you take that annual debt service at $70,151 and you divide it by the original loan amount, so the $1 million, you get a loan constant of 7.01. As you can see, that 7.01 is significantly higher than the 5%. So what we do is a lot of times we educate investors when they come to us saying, I've got a loan or I've got a deal, the cap rate is 6%. And they automatically think that a 5% loan, they're going to be making money, but they don't realize that they're actually paying back principal. So it really just affects the cash flow on the property.
Makes sense. So this is really like true cost of debt, right? Because I think that's the
Yep.
mindset around an interest rate is like, well, the money's only costing me 5%, and the
Yep.
money is getting me a 6% cap rate or 6% return.
Yep.
But this is true cost of debt, if you will, including whatever piece of the principal might be included in your total percentage return. Okay, that makes a lot of sense.
And certainly part of that principle is going back towards your equity. So you're building up your equity base in the property. But when you look at it on a on a cash flow basis, on a cash on cash return basis, that's where you're going to see a drastic difference if you're just using the interest rate versus the loan constant.
Okay. All right. So let's talk about relevance, and maybe this is the next slide, and I apologize. But what's the relevance to the investor with this? Like, why would an investor care about this loan constant? I mean, care is a strong word, because I think you made the case already why it's important. Like, you're loading in the whole debt, but how does it factor in when somebody's looking at a deal, and what are some things they need to consider with this?
Definitely. So, Jamie, if you came to me and said, "I've got this property, it's a 6 cap, 10-unit multifamily. What does financing look like?" So we'll go out to the market, we'll talk to lenders, we'll come back with interest rates, we'll come back with amortization schedules, we'll come back with loan amounts. So really, when you're out there looking for debt on a property, you want to know, A, how much debt, B, what does it cost, and C, how quickly am I paying it back? And as all of those variables change, that will change your cash on cash return. That'll change your IRR at the end of the term of the property. So you really need to understand how all of these affect the financing side of a property, but also that ultimately affects how much equity you're bringing to a deal. So if a deal doesn't cash flow at a certain loan to value or loan amount, you're going to have to bring more equity to a deal. And so Jamie, if you want to go to the next slide. As I mentioned, amortization is one of the variables that changes the loan constant. So if you look at the first set of boxes, you'll see on the left-hand side, the interest rate is 5%. In the top four, I use 4 different amortizations. So 15 years, 20 years, 25 years, and 30 years. Just meaning 15 years, you're paying back your principal amortized over 15 years. Going down to a longer amortization, meaning you're paying back over 30 years. So it's a longer time period, meaning your payments are less. You can see the calculation on the right. At a very short amortization schedule, 15 years, you have a loan constant of 9.49%. That's drastically different than 5% interest rate. So an investor needs to be wary of, oh, great, I've got this 5% loan. It's below my cap rate of 6%. But the amortization really crushes the cash on cash return because you have such a higher loan constant. And on the flip side, if you look at a 5% interest rate, a 30-year amortization, you can see how that loan constant drops to under 6.5%. So that really improves your returns, because you're essentially paying less. Your debt is costing you less over 30 years.
Makes sense. Yep.
The
same. I'm sorry. It looks like the same would apply for the 6%, right? So essentially, the longer the amortization, the better your loan constant is going to be, because that principal pay down is going to be less and less as you go with a longer amortization period.
Yeah, and it ultimately depends on what you want. We've had some investors that come to us and say, "I've got a property. It's a net lease property. It's got a 15-year term on it. I actually want to match my amortization so that when the lease comes due, I've paid my loan back." So they're sort of foregoing some of their cash on cash return or some of their income on the property, so that at the end of the 15 years, they own it free and clear. They've got no debt. They've paid it off. Now they're happy, and they own the property 100% equity. Those that are more concerned with cash flow on a property, the goal is really to extend out the amortization as long as possible.
Gotcha. All right. So let's compare this to cap rates for a moment, a little bit more. So on this top example, 5%, you got 4 different amortization schedules, and it goes from 6.4 to 9.49% on the loan constant, depending on the length of amortization. So let's say you're dealing with a property that's a 7.5 cap. So essentially right in the middle, where 20 and 15 years, your loan constant's higher than the cap rate. 25 and 30 years, your loan constant is lower than the cap rate. What does that mean?
Yeah, it essentially means that your debt is costing you more than you're earning on your income. You're earning on that property. So some of it will depend on how much leverage you have. So if you're in the bottom two rows and you have an amortization of 25 or 30 years and your loan constant is below that 7.5% cap rate, you're in one of those two bottom buckets. The more leverage you apply to the property, you're essentially getting positive leverage because you're earning more than you're paying, than your debt is costing you. So you're essentially amplifying your returns as you add leverage. So if you go from say 60% or 65% or 70% leverage, as you increase your leverage, you're essentially increasing your returns.
Interesting. So this really does. So this tells you, this is a great indicator for how much you should and or can leverage the property and what kind of return that will. So you can, how do I put this? You can have more debt, if you will, leverage a property even more if the loan constant is higher than your cap rate. You can leverage up as much as you, I don't say as much as you want, but you can leverage it pretty high versus if it's below or if the loan constant is lower than the cap rate or higher than the cap rate, excuse me. Let me try that again. You can leverage more if the loan constant is higher than the cap rate, correct? Or am I saying that backwards?
You want, in order to think about this, you want the cost of your debt to be lower than what you're earning on your debt.
Correct.
So if your cost of debt is lower than what you're earning, then as you add more leverage, you're increasing your returns exponentially.
Interesting.
And to your point, when your cost of debt is lower than what you're earning on your equity or on what you're earning on the property and the cap rate, there are other prohibiting factors. There's DSCR ratio, covenants, and these types of things that you have to stay within. But yeah, essentially, higher cap rate deals, you can often increase the amount of debt because there's more cash flow coming into the property that can service that debt. And that's one thing we get all the time is a lot of low cap rate deals. A lot of properties that are trading in say 4, 5, 5.5%. People think that they can get 75, 80% leverage, and there's just really not enough cash flow in the property to cover debt. And so that's why you see those low cap rate deals have leverage in sort of 50 or 60% range because there's just not enough income to cover that debt.
Okay. Is there and this may be so I get the point. Like when you're talking about cap rate to interest rate, bad comparison, load in the actual principal pay down in the loan constant, and that gives you your true comparison. So your point on a 3, 4, 5 cap property, you're going to have to be, you're going to have to bring a lot of equity to the table up front in order for that to work from a loan constant perspective. Is there any direct relationship with DSCR? I mean, I know that there's an impact, but can you predict where the DSCR lands based on where a loan constant is, or no?
Yeah, you can. There's models and way to back into it, and a lot of what we do is when a deal comes in, we'll size it, and we'll have we'll put in a 1.25 DSCR, minimum where it has to meet that, and so we'll size deals on DSCR, on debt yield, on LTV, and whatever is actually the lowest loan amount is probably what a lender is going to go with. Because that's really how they size a loan.
Makes sense. Okay. Good to know. All right, cool. What else do we need to know about loan constant? Should I advance the slide here? Is there some more?
Yeah.
All right.
To what we were sort of talking about and what you had kicked off the conversation with, really, you want to compare the loan constant to cap rates, right? That's where you want to know where your return is. So in this example, we have cap rates ranging from 6% up at the top down to 8% at the bottom. And then in the column to the right, we have just a constant loan constant, same loan constant, 7%. So I just used, flat loan constant here. And then I used a flat loan amount. So you can see in the column to the right, I used 70% leverage, and we're assuming, $1 million deal. So 700K of financing. You can really see how at the very top row, 6% cap rate. So the cap rate is 6. The loan constant is 7. So our cap rate is below our loan constant. Our cash on cash is 3.67%. That's not a great cash on cash return. if you go to the very bottom, we have an 8% cap rate, which is higher than our 7% loan constant. We have a 10.33% cash on cash. So you can see as your cap rate, in this example, as your cap rate moves down the column or essentially increases, your cash on cash increases.
Makes sense against the loan constant, which is constant in this case.
Which is 7%. Pun intended.
I get it.
Yeah, I mean, this example really shows, when you are comparing cap rate versus a loan constant, you're holding everything else equal. Higher cap rates, higher cash on cash. Lower cap rates, lower cash on cash.
Makes sense. Very good. Okay, cool.
Yeah.
What do we got here? Positive leverage.
Yeah, so this is sort of holding everything the same, everything equal, and then changing the loan amount. So this is something we discussed earlier, where if you have that example where your cap rate is higher than your loan constant, as you increase leverage, as you increase debt, you're going to see your cash on cash return increase as well. So in sort of the blue columns, we have cap rates. We have a cap rate of 7.
Yep.
We have a loan constant of 6.5, and then in the third column we have our LTV, or loan amount. And so you can see it starts at 60% at the top, and then as we move down, it increases to 80%. So we're increasing our leverage. You can see our cash on cash return goes from 7.75% to 9%. So in a real world example where you have a deal that's a 7 cap multifamily deal, and your loan constant is 6.5%, and in that instance, I would say increase your debt, increase your leverage, go from 60 to 70, as you and obviously staying within a lender's parameters of, like we said, debt yield and DSCR and all those other things, but in those types of deals, that's where you want to sort of step on the gas and increase financing, because you're just going to exponentially increase your returns there.
Makes sense.
Yeah, and then on the flip side, this is where we have a cap rate that's lower. So cap rate is staying the same at 7. Loan constant is 7.5. So we have a cap rate lower than our loan constant. As we move down and increase leverage from 60% to 80%, you can see our cash on cash decreases from 6.25 to 5. So this is an instance where we're paying more on our debt than we're earning from the property. And so as we increase our leverage or increase the amount of financing, our returns are decreasing. And so this is an instance where a lender is probably going to scale back the loan amounts, and there's not enough income to cover debt service. But from an investor's standpoint, this is where you may not want to be as leveraged, because your returns are just going to diminish as you do increase financing.
That makes sense. So the for an investor that's doing the underwriting on a deal, if they wanted to incorporate this, I mean, this is a fairly, if you have a sense of what your debt would be, like if you have some, all right, this is this size of loan, I can get a 30-year, probably around 5%. Like you kind of make some assumptions on your underwriting as far as what your debt will be. I mean, this is a very quick back of the napkin approach. It seems like, all right, what's the cap rate on this property? If I buy it at the price I think is accurate for it, let's compare that to this. And now I'm going to know how much can I leverage and what's my potential return based on that. Fair?
Yeah, definitely. And I agree. It is a quick, back of the napkin calculation. I do it every day on every deal that comes in. Yeah. I do it every day on every deal that comes in. And it just sort of gives me a sense of, is this going to be a higher leverage deal, a lower leverage deal? Is this something that, it sort of gives you direction. It's not the end all be all, but, for you guys out there investing, it's just another tool to arm yourself.
I think it's great, because I've been on calls and masterminds or whatever, where you hear it like it's 3.5% interest rate on a 7 cap. I mean, how can you lose? And it's like, well, I mean, it's a pretty good spread, but still, like if you load in, like what's your debt service going to look like? What kind of amortization you're going to get? A lot of credit unions are offering 20-year, right? Like there's some places are just at 20. So, okay, on 20 years of amortization against whatever you feel, if it's 3.5 or 4% interest rate, what's the total debt going to be divided for the year, divided by the overall debt on the property. And
Yeah.
if that number is 7.5, well, all right, your 4% interest rate against your 7% cap rate all of a sudden doesn't yield you the kind of cash on
Yeah.
cash that you might have thought. You're going to be surprised after you acquire at, why am I not making money on this thing, right? Or
Yep.
making the kind of money I thought I would on this thing, right?
Yeah. No, you're spot on. And another thing to analyze is that same deal. Say I have a loan at 4.5% in a 20-year amortization with a credit union, but now say I have a 5% loan, but a 25-year amortization.
Yeah.
That higher interest rate deal actually might be a better deal, even though, it's a longer term and you're paying back your principal over a longer period. Your cash on cash might actually be better, and you might be better served going into a higher interest rate loan because that amortization can really play with the loan constant.
Makes sense. That makes perfect sense. Yeah. It's not always about the, I got the lowest possible interest rate.
Yeah.
That's it. There's a lot of variables to it. So
Yeah.
this is about Stacksource. So we'll come to this in here in one second. But anything else on the loan constant that we should know about? Or do you feel like I got my questions answered? I think it's a great tool, but is there anything else that we should know about with the loan constant? Any other pieces of advice?
Yeah, I mean, there's a lot of factors that go into it. So what I tell investors all the time is, if you get an interest rate, there's more to the picture. And the way to really look at that picture is understanding the loan constant, understanding all the variables that go into it, how it affects cash flow. One deal might be good for some investor and bad for another. And so it's definitely not the answer to everything, but it's a tool that investors should be aware of and use and sort of incorporate into their models as they're looking at properties.
Very, very little effort to get a quick
Yeah.
calculation on it. Again, because I know it's extremely little effort to look at cap rate versus interest rate. That's easy. But
Yep.
just doing a quick math equation, you can figure out, okay, what's my cap rate versus my actual loan constant, total debt,
Yeah.
principal plus interest on this thing, and go from there. I'm trying to think. The only other thing I could think of is, how does this factor in, if at all? And again, my brain isn't that big, so it might be a dumb question, but how does the interest only, if you get a 3-year IO, for instance, on a
Yeah.
property, 3 years of interest only, how would you utilize this? Is it while you worry about that in year 4, because you're going to see your cash on, I mean, obviously you're going to see your cash on cash go down when you start paying principal, but
Yeah.
you just use it as, well, if your hold is 5 to 7 years, at some point you're paying principal, and at some point it's going to jump over your cap rate, so it becomes less of a cash on cash return? Or how do you factor that in?
Yeah. I mean, it depends. Usually, as usually with an IO, either, full term IO or partial term IO, usually that IO is either offered by the lender to get the deal done as sort of a kicker. Or oftentimes it's done where there's some construction component or some value add component. So there's, it's IO is tough because there's usually different other things going on. But yeah, I mean, for IO, whether it's 1 year IO, 2 years, or 3 years, for that period of time, there is no amortization, so you're really comparing the interest rate to the cap rate. But yeah, once year 4 kicks in, you can do the calculation at that time. You can use your pro forma and sort of go out to year 4 and say, okay, here's what my NOI is going to be. Here's where we think cap rate's going to be. It's probably not as good of a tool to use in the future like that. It's better, I think, for acquiring stabilized properties where cap rate's really not going to change, because in a value add play or something like that, things change, and then your cap rate's out the window, and your loan constant's out the window, and you're back to square one, essentially.
That's rough, right? Yeah, makes sense.
Yeah.
Okay. Good stuff. All right. Well, tell us a little bit about Stacksource. I love
Yeah.
this company. I love what Tim has done with it. I love what you do. So I'm so happy to plug it. What is
Yeah.
Stacksource? Tell us about it.
No, I appreciate that. We are really just a financing platform for commercial real estate. You can see we've done about 50 deals in almost 20 states. We've got capital advisors in California, Denver. I'm in Chicago, Atlanta, New York, New Jersey. And then we facilitate and arrange financing for all different commercial asset types. So we'll do 5 units and up, multifamily, office, retail, industrial, self-storage. We'll look at funky asset types like gas stations, churches. We've seen a lot of different deals, and then we'll do everything from ground up construction to value add to repositioning. and then simple, acquisitions and refis of stabilized properties. Our lender pool is about 500 lenders across the country, ranging from banks to credit unions to life co. We also work with agency lenders, CMBS lenders, private lenders, debt funds. So it's really a very it's a fantastic platform that just increases speed, technology, efficiency, and transparency, and really the broad reach. Just it's amazing.
Pretty easy to use too. I know I put a whole bunch of information into your, excuse me, into the website to get in touch with you and talk through the potential refinance on a property here coming up. And pretty user friendly. And the service so far that we've gotten has been great. So stacksource.com, correct?
Yep, stacksource.com. Everything's on our website. If you have any questions directly for me, I'm at chris@stacksource.com. Feel free to shoot me a note, or you can track one of us down on the website.
Perfect. Well, Chris, I really appreciate you going through Loan Constant, Mortgage Constant, what Stacksource is, and everything else like that. It's been great. I appreciate you being on, and I hope you have a great day.
Definitely. Thanks, Jamie. Thanks for having me.